What's up, military real estate investors? Mark Yancich here again with Active Duty Passive Income. And this video is going to be about a very exciting aspect of the VA loan, which I think is hugely underutilized by most military members. And we're going to talk about how easy it is to refinance your loan to get a lower rate, if obviously low rates are available, and why it's important to keep your hand on the pulse a little bit with what's going on in the rates, so that if the rates do the right thing, go down, that you can then take advantage of this amazing thing called the VA IRRRL, or IRRRL, which all that really stands for is the VA Interest Rate Reduction Refinance Loan. And again, it's awesome. So let's kick it. So I'll start off by saying I have done this many times, and I'm going to use my California home as an example. My first interest rate that I started off with in 2018 was about 4.5%. And then about a year later, I brought it down to 3.85%. And then about a year after that, I brought it down to 2.75%, until finally I brought it down to 2.25% just recently. And that's literally changed my monthly payments by, I think, a total since the beginning till now by about $600 a month. That is a big deal. I mean, that is literally a vacation I can take with my family. So needless to say, this is a very important thing to understand and to take advantage of when possible. Now, there's a lot that goes into lending, of course, and there's a lot of different steps and metrics. And, you know, that's why there are loan officers, processors, underwriters, closers, all sorts of people that are lined up trying to get your loan to the finish line. There's a lot of work that goes into this. But for you as the borrower, there's three main things you need to understand just to make sure you can kind of gauge whether this is going to make sense for you, and also to understand what the first thing is that a loan officer is going to look at to see if you qualify and if it makes sense for you to do a VA IRRRL. So rule number one is your interest rate has to fall by at least 0.5% or more, obviously. Basically, the VA decided if it does not fall by at least 0.5%, it just isn't worth doing for them to go through the trouble. Rule number two is the 210 days and 6 months of payments rule. Essentially what this means is that the first payment made on the previously closed loan has to have been at least 210 days or greater ago prior to this newly refinanced loan's closing date. So the same home that you are now refinancing, if you made the first payment on it over 210 days ago, then you can refinance it now. Or you can actually start the refinancing process earlier, but just the closing date of this refinance has to be at least 210 days. And on top of that, another layer is you have to have had at least 6 complete payments happen up until that time. Moreover, if the previous loan was closed within the last year, the new lender will be required to ask your current servicing lender for a full history ledger of the payments that have occurred thus far. Rule number 3 is the 36 months recoupment rule. This is often misunderstood or kind of calculated weirdly. It's really simple, and here's how to think about it. Basically, after you perform your VA IRRRL, the savings every single month, so the delta between what your previous payments were and what they are now, let's say it's $200, right? That savings, when multiplied by 36 months, that total needs to exceed all of the fees in conjunction with the loan. And those fees include title fees, VA funding fee, and of course, any lender fees. So those 3 things are it. That's it. That is the most important things that you need to understand as a borrower, and that the loan officer is going to look at, immediately when trying to see if you qualify for a VA IRRRL. And again, there's other things that will be considered. The loan officer, the processors, underwriters will be taking a look at, but that is the big hurdle right there, those 3 things. One thing to note, I would be remiss if I didn't make sure everybody understands that your 30-year loan time frame starts all over again. A lot of people get freaked out when they learn this. They're like, wait a second, what if I was 5 years into paying off my 30-year loan and now I have to start all over again? Well, first of all, if you're actually far along into paying off your loan balance, excluding any kind of fees, and sometimes there's credit back or something, or sometimes you get an interest rate that's not rock bottom, but you get a little bit higher and you might get some credit back. So there might not be any fees at all. Point is, outside of any fees, your loan amount won't increase. So let's say you got a house for $200,000 and you decide to do a VA IRRRL when you're at $160,000 left in principal balance on that loan. that's where it's gonna be, right? That's where it's gonna be when you restart your 30-year ticker. As I mentioned in the previous video, when you're comparing a 30-year versus 15-year loan, that gives you flexibility. Your debt to income ratio goes down because not only do the payments go down, but the total loan balance goes down, so the payments go down because of that as well. And you can also pay it down faster if you want to. If you had 25 years left, you can adjust in your login portal with whoever the lending servicer is. You can go and adjust and make sure you pay it off in 25 years still. And your payments are still gonna be lower because your interest rate is lower. So it's a win-win regardless. Don't get hung up on the fact that you now have a 30-year time frame or a 30-year term to pay off your loan. It's okay. It is worth it to have that flexibility, in my opinion. This isn't financial advice. When I'm thinking about cash flow, I'm thinking about, I wanna minimize my expenses every month and I wanna increase my income every month. So this is a win. All right, this video is short and sweet. Please subscribe, like, share, comment, do anything to help us continue promoting this channel, to continue impacting other service members, veterans, military spouses, and their families on their path to financial freedom. This is Mark Yancich with Active Duty Passive Income. Thank you so much for watching. Take care.